Hello and welcome to the 9th of our Minds and Money 5 at 5 shows, which this week is sponsored by Whittle Consulting. For those of you attending 5 at 5 for the first time, the aim of 5 at 5, 5 guests at 5 p.m, is to maintain engagement between investors and miners through a lively, interactive format during the current situation. A few admin announcements before we start. To make it as interactive as possible, please have your video switched on. To ask a question, you have two options. You can either submit them via the chat function, which is at the bottom of the screen, or even better, you can wave that. You can wave your hands via the invite participants function, which is again at the bottom of the screen. I will unmute you and you can then ask your question live. We'll also be having polling questions throughout the webinar where you can vote. Being towards the end of the week, we encourage you to bring along a glass of wine or a beer to relax, sit back and enjoy. And for this week's show, we have a star-studded lineup of guests. So without further ado, let me go and introduce them. I'd like to hand you over to Jochen Steiger, founder and chief editor of Commodity TV, a pioneer in online mining channels with over 1.2 million viewers and counting. A warm welcome to Jochen.
Andrew, thank you very much, and also very warm welcome to everybody here from where you're coming all over the world. As I'm in Switzerland at 6 o'clock, we are allowed to have beer, of course, so feel free to make sure you have also some cold drinks. I see already Paul in Lisbon. Perfect, that's good. And yeah, 5 by 5, as Andrew said, shall be also a little bit of fun, not really too serious, but of course we have a lot of serious and very interesting information for you guys. And before I introduce our panelists, we're gonna have a short poll here for you guys. And as my birthday was 9th May, I have no idea from where Andrew has that, but it's right. And which famous pianist do I celebrate my birthday with? Is it Frédéric Chopin, Billy Joel, Elton John, Liberace, Franz Liszt? So you can now do your polling. By the way, I play also a little bit of piano, but I'm not famous what that belongs. And so I still have to do my stuff here, of course. Yeah, so let me introduce, whilst you guys are here polling, let me introduce briefly our guests we have today. And I must say, Andrew has put together a fantastic variety of good mining people. First of all, we have Jonathan Goodman, the executive chairman of Dundee Corporation. Then my friend Bradford Cooke, CEO of Endeavour Silver. Then Raziel Zisman, leader sustainable governance initiative of Whittle Consulting. Then also Tim Warman, whom I know very well, CEO of Fiore Gold. And then last but not least, Matt Geiger, managing partner of MJG Capital. Welcome, guys, and I hope you're doing all well, as I saw before here, and everybody is in. That's perfect. So where is the poll? Let me see. Okay, we have Elton John, Frédéric Chopin. I can imagine why Elton John, but Mina, can you end the poll now, please? And it is Billy Joel, ladies and gentlemen. Okie dokie, so we learned something. Okay. So let's get started with Bradford Cooke, the CEO. Who is that? Okay, good. It was not me. So Bradford Cooke, CEO of Endeavour Silver. Bradford Cooke is a professional geologist and entrepreneur with 40 years of experience in the mining industry. He has specialized in the formation, management, and financing of exploration and mining companies and the acquisition, exploration, development, and mining of mineral properties. Endeavour Silver is a mid-tier precious metal mining company with 3 high-grade underground silver gold mines in Mexico and, of course, producing silver and gold. So, Brad, the floor is yours. And what's the outlook for silver, and what's the outlook, of course, for Endeavour Silver, please?
Hey, Jochen and Andrew, thank you very much for inviting us to participate today. Short-term outlook for silver and gold, I think, is pretty clear. We've entered into a new cycle in the last year or so, and last week was a lot of fun with a little bit of a breakout, not only in gold, but especially for silver. Let's talk about the relationship briefly between gold and silver. After every market crash in my career, gold has typically been the leading investment sector for at least 2, sometimes 3 years following a market crash. And yet gold and silver do get dragged down in a crash because everything's for sale. Investors scramble for cash. So that's what happened this year, obviously. The March panic took everything down, but gold literally recovered everything it lost in the panic in less than 2 weeks. Silver struggled to recover what it lost in the panic all the way up until this past week. And so that lag time between silver and gold is so typical of the two precious metals. Wherever gold goes, silver tends to follow, but with a lag time. And the reason is very simple. Gold is primarily a monetary metal and nothing but. Silver is primarily an industrial metal, and only from time to time do investors rediscover the precious nature of silver. And we're in that phase now. By the way, this is the earliest stages of the cycle, so I see quite a long runway here, measured in years, not months, before we get to a peak in this cycle. Endeavour, as you mentioned, is a mid-tier precious metals producer. We have 3 high-grade underground silver and gold mines operating in Mexico. Our market cap is about 280 million US, 400 million Canadian. We have a clean balance sheet. End of the quarter, we were running 27 million of working capital, no long-term debt, and almost half the working capital, more than half the working capital is cash. So that's a quickie update on the company. I think there's really 4 ways that we can create value for shareholders, both short and long term. And the first one is our ability to turn our own operations around. We have previously specialized in buying small, underperforming mines in historic districts in Mexico and bringing the money and the expertise needed to restart them, modernize them, expand them, and ultimately make them profitable. Unfortunately, last year there's no way to sugarcoat this, our worst year in operations ever. And we took a significant operating loss last year. We recognized that it wasn't just one thing wrong, but many things wrong. And so we literally did a clean sweep at the operations over the past 12 months. That's the bad news. So the first value proposition is return the mines to profitability in 2020. In our first quarter, we showed that our worst performer last year, our first and largest mine at Guanaceví, has actually turned into our rising star. It's already broken through. We've completed the operational turnaround, and we had cash costs of $9 an ounce in the first quarter at Guanaceví. We actually had cash costs in a negative territory, now to the gold credit, at our second mine, Bolañitos, but we're still investing heavily there to finish the turnaround at Bolañitos. And El Compass, our third mine, is running close to our plan. So that's value proposition number 1. And I think we've already arrived in terms of turning the operations around. Value proposition number 2 is that we have the best organic growth profile in the sector with not 1, but 2 bona fide new district scale discoveries awaiting development. The largest and first, Terronera, is our immediate focus. We're just doing the updated economics on the pre-feasibility study, and then we'll move to a final feasibility on Terronera. By the way, our production profile this year is in the order of 6 to 8 million ounces of silver and equivalents at 100-to-1 ratio. And we think Terronera can come on in the same range. So Terronera for us represents a doubling of our production once it's up and running, and at less than half our current costs. So it's a double whammy for us. It allows us to grow and become much more profitable because of its incredibly low cost profile. The value proposition number 3 is that we have lived and died by the drill bit. Every one of our ore bodies, every one of our mines was a discovery of our exploration group. And we continue to focus on both brownfields and greenfields discoveries. We just announced yesterday a new discovery at Bolañitos in Mexico. And we have the portfolio of 3 world-class prospects in Chile to try and get into something of larger scale. So last but not least, from time to time, we do pull the trigger on mergers and acquisitions. For instance, each of the mines that we currently operate were acquired privately from Mexican owners. And so this combination of turning the operations around, building our next new mine to double our production and half our costs, continuing to explore to expand our resources and extend our mine lives, and scour the planet for opportunities. These are the ways we can create value for Endeavour shareholders.
Fantastic. Brad, thank you very much. Yeah, there's a question from Jacob Ambrose Wilson, and he is asking, why has global silver production seemed to have suffered the worst from mine shutdowns following the COVID-19 outbreak? And also a question in addition to that from my side. Where do you see the market balance today? Meaning, yeah, if we talk to other producers, like it looks a little bit like the demand is still rising, but the production is really shrinking from primaries, but also, let's say, as a byproduct scenario. So maybe you can answer those two questions in one, please.
I'll answer the second one first. Basically, silver being primarily an industrial metal and primarily a byproduct of copper, lead, and zinc mines, actually has a significant amount of above ground finished goods available for manufacture. And that's really what's capped the silver market relative to gold. It's the reason why there's a lag between the move in gold and the move in silver. We have to consume the above ground inventories to the point where they have to be replaced before silver pops. And so indirectly, I'm assuming that the pop in the past week shows that there's an issue with available metal above ground. So I think that because we're primarily a byproduct metal, and the swing factor on the demand side are the investors who went completely absent in the last bear market. If you look at coin and bar demand and ETF demand, up until last August, they were flat to falling for several years. And only in starting last August did we see ETF demand pick up sharply and continuing to grow today. In the first quarter, coin and bar demand quadrupled over the first quarter last year, year on year. Mm-hmm. So there's clear evidence now that the investors are returning to silver. And your second question, Jochen?
Yeah, why has global silver production seemed to have suffered the worst from mine shutdowns following the COVID-19 outbreak?
Well, many Latin American countries went straight to shutdown of non-essential industries. So whether it was Mexico or Peru or Argentina, basically everybody had to slam the brakes on due to government mandates. Now, it does not apply to every country, but Mexico and Peru are the two largest silver producing countries in the world. So there is going to be a supply impact from our now 7-week shutdown. And it's just recently that the Mexican government indicated that between May 18th and June 1st, subject to health department approvals, the mines can restart. And so we're actually in the middle of restarting our mines this week.
Mm-hmm. Bradford, how do you see longer term the impact of e-mobility onto the silver price? I mean, we know already that with solar, we need a lot of silver, approximately 3 million ounces per gigawatt. Yeah, so that's really a lot which is used here. But on the other hand, I think a lot of people don't know that we need approximately 2 to 3 ounces silver for a e-car. It doesn't matter if it's a plug-in e-car or it's a hybrid. And in addition, we have silver oxide inside the batteries. What is your take, let's say longer term, within the next 3, 4, 5, maybe 7 years, how this demand side will develop?
Silver is a very interesting metal. It's, I think, the most versatile metal used. And if you go back 100 years, its only use was for coinage. It was money. If you go back, starting around 50 years ago, it became primarily, silver was used for photographic papers and films. And that was the theme all the way up until digital photography in the 90s. So I talk about 3 disruptive technologies in silver in this cycle. Starting in around 2000, we saw the arrival of silver nanotechnology for electronic circuitry and the explosion of electronic gadgets. So every electronic gadget now has silver in it. And the explosion of that, electronic gadgets, coupled with the emergence of China as a consuming nation, led to, I think, the first disruptive technology that drove the price of silver from $4.50 up to the $49 peak in 2011. Starting around 2010, second disruptive technology took over as the fastest growing component of silver demand, and that was the solar photovoltaic cell. And solar photovoltaics have been around for many years, but they only became economic propositions in around the 2008, 9, 10 period. And this electric car idea that you mentioned, this is the third disruptive technology for silver. And most people never think of silver when they think of the electric vehicle. And we talk about cobalt and nickel and lithium, all the battery metals. But did you know that 5.5% of silver last year went into conventional automobiles for their digital circuitry? And did you know that an electric vehicle uses at least twice as much silver as a conventional vehicle? If you believe any of the 10-year forecasts for the EV business, the impact on silver will be an additional 100 to 150 million ounces a year of demand just for EVs. Where will that metal come from? So I think this combination of three disruptive technologies for silver, and then you layer on the monetary demand, which is just now waking up, I think we have a very exciting phase coming for the silver.
Fantastic.
Yeah, okay, I'll jump in with a quick question here if you don't mind.
Please.
Brad, many of your, at least formerly, silver producing peers have gone out and acquired gold assets in the past year or two. You said you guys are potentially on the hunt for new assets. Are you focusing on primary silver, or is anything within the precious metal mandate work for you? And also jurisdictionally, if you could share generally where you're looking, that'd be helpful, I think.
So our philosophy from inception 16 years ago was that we're interested in silver and gold. The two are indivisible. They hang out in nature. They're best buddies in nature. So almost every deposit of gold has silver and vice versa to varying degrees. We have no problem taking on pure gold. We have no problem taking on pure silver. The Americas are hunting grounds. So anywhere from Alaska to Tierra del Fuego. As it turns out, Mexico and Peru are the two dominant countries for silver production. So all of our current assets are in Mexico. That doesn't mean we're not looking elsewhere. And it doesn't mean we're not looking for gold as well. Even copper, because copper also is one of the buddies of gold and silver. In terms of our own metal mix, we have right now about a 50-50 split by revenue, silver and gold. And with the development of our next mine at Terronera, which is about 65-35 silver gold, we will become more skewed towards silver. And our second discovery, I didn't mention it, but it's called Parral. We already have 45 million ounces drilled out, and we think we can double that. Parral is silver only. So this silver-rich portfolio that we're proposing to develop actually gives us a little bit more license to acquire more gold.
Fantastic. Time for one last question. You can also raise the hand if you click on participants. There is a blue hand you can raise, and then Mina and Andrew can put you in. Okay, then I have one last question. What's your prediction for the silver price in 2020?
Oh, danger, danger. Well, so whenever somebody asks me that, I defer to the charts. Basically, again, gold leads, silver follows. The resistance on gold is 1880. We're not there yet, so there's still another move before we hit significant resistance on the gold side. The equivalent in silver would be about 19, which is just under the 100-to-1 ratio, and we're not there yet. I think that's coming shortly, as in months, not years. And so I think we'll see at least $19 silver this year. Next year, a little bit higher.
Super. Okay, perfect. Bradford, thank you very much. Very compelling, and yeah, good luck with everything. And I think silver especially has a lot of potential. Gold for sure, but silver really has to do a bit more to really keep up with that. Let's come to our second guest, Raziel Zisman, leader of Sustainable Governance Initiative from Whittle Consulting, who Andrew has mentioned, of course, earlier, are this week's sponsor. Raziel co-founded and leads the Sustainable Governance Initiative at Whittle Consulting, helping implement integrated strategic planning in the mining sector. Raziel, I know that Whittle Consultancy has doing a lot of work in mine optimization and strategic planning. Can you tell us a little bit more and how you see the marketplace evolving? Floor is yours.
Thank you very much. Thank you to you, Jochen, and to Mines and Money. It's a great forum. Whittle Consulting goes back historically to the invention of the first pit optimizer by the father of the current CEO, Jeff Whittle. But we've gone way beyond that. We sold that business over 20 years ago, and 20 years ago we started Whittle Consulting, whose vision is to, once finally you get to mine, make the most out of it. And we look at the mining business as a business, as a system to make money, and it's a system that has bottlenecks. And what we try to figure out is how to squeeze the most money through the bottlenecks. And it's like playing a Rubik cube or a fourth dimensional chess. We look at the time factor. And that's what we do. And we've been operating, perhaps Mina could show, I've prepared a very short slide deck to speak with images what is hard to describe in words. One thing I like to mention, many people in mining know about the Whittle pit optimizer. And to this day, when I approach or we talk to them, they think this is what we do. We sold the Whittle business to Geovia, which is today Dassault. We get a royalty from it, and we've gone into the full system optimization. One question that people ask us is, do we do only open pits or underground? We do everything. We can optimize very complex operations with many mines, open pit or underground, and several mills. And we go through the whole system from mining through logistics. So here we are. Let's start. Yeah. So integrated strategic planning is a way of looking at mining as a system. If we go to the next slide, please, Mina. We've been in business for 20 years, and we have clients all over the world, some of the largest companies in the world, and we also work with juniors. We are a relatively small company, but we punch very much above our weight. And we really like mining, and we like good miners, and we enjoy greatly working with excellent teams. Next slide, please. So this is how we look at a mining operation. Click, please, Mina. And we look at it's a system to make money. From left to right, we go through a pit or an underground, phases, mine schedule, cutoff, blending, stockpiles, processing, production mix, logistics, and going to the market. And the key concept we look at is how much there are bottlenecks in every system, how much money we can put through the bottleneck, per bottleneck unit. Next, and at the bottom of the slide, you will see our probary software and capital. So if we look at a mining operations as a system, we will first identify the bottlenecks, as it's not so straightforward. We had a client, a very large company, and the people participating in our seminars, to which I'll come later, there were 6 views as to what the bottleneck was in the system. It is not immediately apparent, and the bottleneck changes over the life of mine as well. Instinctively, in most mining companies, when a bottleneck shows up, people want to throw capital at it. They want to throw capital, and we say no. The last thing you do is throw capital. First, understand what you have and what are the levers to increase value. Then, once you figured out, you use capital, and then at the bottom, you see the probary. Probary is a very powerful optimization software. Sometimes we now use cloud-based computing. We use several hundred computers at the same time. We can push through a lot of data and do very sophisticated analysis. And the last thing I'll say with this image is you go back and forth over time. So for example, what you mine has an impact on the mill and vice versa. And the idea is how to extract value at the end of the day. A high grade is great, but if you have high production costs, high processing costs for that kind of mineral, then you're back to square one. So let's go to the next slide, please. In the next slide, you see how things evolve over time. This is a base study. And then if we click again, you will see as we go through the analysis, how the profile for the production of the life of mine will change. As we analyze the pit schedule, phases, the mine schedule, the cutoff schedule, the stockpiles, which are strategic stockpiles, simultaneous optimization, processing, the product mix, and the logistics schedule. And then you come, so you see the profile at the end is very different from the original profile. And if we go to the next slide, you'll see the impact of that on cash flow. So that's the base model of the original plan. And if we click again, and this summarizes what we do. We bring cash forward. And this is a snapshot today of the mining operation. Gives you a lot of the red line shows you the cash that you brought, and it's several $100 million very often. And this also in the sustainable governance, what I do has a great significance to governments. Governments want you to make as much money as possible. Funny, your shareholders also want you to do that. because you will increase the amount of taxes you pay, which benefits the mining industry, because from the taxes, they can do all the CSR, build schools and roads and so on. So if we go to the next slide, the next slide shows 4 cases. These are real cases. Some are gold, some are copper. And in some cases, the overall cash over the life of mine increases. Sometimes it's neutral, but in all cases, you make more cash earlier, which gives you optionality as a company. You can buy the next door mine, which is going on the blue line. You can do more exploration and discover more, and so on. And that's the long and the short. And also, funnily enough, over time, we found that being optimized gives you more sustainability. You use water more efficiently. You use energy more efficiently. You don't mill material to a very fine grade when you don't have to. And one of our clients last year ran the carbon, they realized they were 30% less carbon efficient, more carbon efficient. So that went straight to their boardroom. The carbon footprint was reduced. So there is an elegance to the whole process. When you do things well, there's a beauty to this, and mathematicians know about this. Anyway, next slide, please, and I think we are done. Thank you very much.
Super. Raziel, thank you very much. Any questions, comments here, especially from the miners?
Actually, Raziel, I've got a question for you. How are you finding the travel restrictions impacting your ability to work with clients right now?
You know what? Funnily, is we don't have to travel. We used to. We traveled a lot to go to conferences and so on, but we find we can do a lot of what we're doing remotely now. We would visit a mining operation, and the reason for visiting is to speak with each manager in their office to ask for their numbers. But now everybody is on Zoom. Everybody's trained on Zoom. So we found we can do it, but most of our work historically was done in Melbourne or with consultants in, our technical guy in the States is in California. So the brain work was done always in an office. So when COVID happened, as you probably know, we give a seminar where we travel around the world. We rent a room with people that travel, and it's, now we can do it globally. And we're launching the next seminars on the 28th, 29th. And there's a schedule now. So it's a new world for us. It makes it easier. Our costs for clients for the seminars have lowered, and our ability to deliver our services has improved. It is, for us, it's a win-win.
Mm-hmm. I have a question. How do you, let's say, get paid? I mean, those are quite impressive numbers you have showed us. So you are also working like on a success fee, because it would maybe make sense, or like something like an NSR?
Jochen, I love you. Very good point. I'll give you an example. And this is on public. For one company, it happens not in every case, but in many cases, we actually increase the reserves. And in one client case, the reserves went up by 80%, 1.6 million ounces. And we joke, I wish we had a success fee on that one, because what we charge like a well-paid, like McKinsey and so on, a well-paid consulting firm. They are reasonable. We will not engage with a client unless we see an NPV improvement in the range of $50 million or so, significant. Sometimes it's just, and depending on the project, of course. But the other value of what we do when we start the full engagement, we meet with a company, with each department, and we replicate their system. And in about a third of the occasions, something doesn't fit. We cannot replicate it, and we find there is a disconnect within the mining operation. So our involvement makes their process more robust. They discover there are flaws or there are inconsistencies and so on.
Mm-hmm. So you should have taken 1% of the higher reserve physical.
Yes, Jochen, you are correct. Thank you.
Yeah, any more questions?
Or take your payment in shares.
Yeah.
Actually, we do that with juniors. Large companies prefer to be invoiced, but if we like the team and we like the project and we see the upside, we're quite happy taking the project. And the reason being is when you go to a large company like a Hekla, for example, you want to bring your best foot forward. And Hekla know us quite well. And increasingly, teams are getting to understand the value of doing that. The other thing, with several funds ask us to look at projects before they invest as part of the diligence, and we give them our view as to the potential upside of the existing project. And if you want, I'll happily speak to any of you offline. We don't have the time to explain exactly what we try to accomplish.
Mm-hmm. Fantastic. Okay, fantastic. Thank you very much, Raziel. As time is moving forward, we want to make sure that everybody has the same amount of time so that we are equal. Thanks for your great presentation here, and really interesting what you are providing to the companies. Two common threads running through Raziel's and Brad's comments has been how the industry has been reacting to COVID-19 and what does sustainability mean for the mining industry going forward. Our next guest is Jonathan Goodman, who is Executive Chairman of Dundee Corporation and has over 27 years mining investment and operating experience. Over a distinguished career, he has built up extensive knowledge and relationships in the global mining and resource finance sectors. Jonathan, what's your perspective on how the mining industry stays sustainable?
Well, thank you. First of all, I'm going to break it down into two parts to it, because we look at the mining industry at Dundee Corporation. One of the companies that I've founded and been involved in for many years is Dundee Precious Metals, which is an operating, producing company. And Raziel knows us very well. I think we've done some work with Whittle. I saw our name on our logo on your slide, and I know we're very happy with the work we did with you guys. But the mining industry per se has done a great job with sustainability. And you talk about, a lot of mines that were shut down weren't shut down because of COVID-19. They were shut down because governments asked them to. And a lot of other places where the countries don't have the social safety net to afford being able to shut down, mining companies were some of the star players. They were the first to contribute to the local hospitals. They helped with PPE. Keep in mind, a lot of PPE our miners wear every day when they go underground. And the mining industry in the last 10 years has changed so much. As an industry, we've embraced ESG. Is now seeing ESG as a buzzword amongst investors all over the world. Well, the mining industry started embracing this many years ago, not because of any reason other than it's just good business. Deal with your environmental issues now, and you don't have a problem going forward. Get to know your communities, be part of the community on the social side, and practice good governance. And we're starting to see benefits of that. A lot of the mining companies are the pillars of the community. And Raziel mentioned a lot of it is embracing technology. And the reason a lot of mining companies have been able to, the ones that stayed open, do well under COVID-19 is, when you used to go underground and see a drill rig underground, you'd have 3 or 4 people kind of working around that underground rig. Now you have one person. And if you actually talk to the shift supervisor, he just wants that one person not to touch anything, because lasers and computers do all the work. And there's a company that we're involved with called MineRP, which we're involved with through Dundee Precious Metals. And they used to joke that the mine of the future is going to only need one person and one dog. And the person's there to take care of the dog, and the dog's there to make sure that the guy doesn't touch anything. So we've come a long way with technology in the mining sector, and we should have it. The other side of the mining industry, which is the mining investment industry, and obviously I've been a big part of that. We have been major investors in mining and mining companies our whole career, particularly my career. And Mark Twain used to describe a mine as a hole in the ground with a liar on top. And present company excluded, in most cases, Mark Twain was right. And what we find is if you listen to the story of the average junior company, you find out that, and do some valuation work, most of these stocks offer great value. The problem is the difference between the good investments and the bad investments aren't related to the story. They're related to the fact that a lot of times the stories are over embellished, and a lot of stock promoters overhype what they really have. And so at Dundee Goodman Merchant Partners, we do a lot of investing right through the whole mining spectrum, mostly on the junior and the mid cap side. We do a lot of due diligence. Before we make a significant investment, and then we usually sign a CA, and we've got a team of professionals, and we go and take a deep dive due diligence look at what we're really investing in. We do a full audit of the resource when it's necessary. We look at how they calculated the resource, how they wireframed it up, and more times than not, we end up not investing because of things we see. And I think as an industry, to stay sustainable, we need to do a better job on the technical side. We need to actually have it so that an investor who isn't a geological engineer and have a staff of 9 experts like I do, be able to read a technical report and know that they can really trust and count on a lot of things in that report. And we're a long ways from that. So I do think that the investing side of the business needs to come a long ways if we're going to invite and have generalists come back into our sector. Because the reason the generalists left our sector is not because of metal prices as much as it is because they bought things that they thought they bought a hammer and found out that they bought a piece of wood. And that's a bigger problem that we have not addressed, and I think we need to address it.
Mm-hmm. Thank you, Jonathan. Questions from the audience, of course, are very welcome. If you still make up your mind, I have a question here for you, Jonathan. One of the big issues facing the mining industry before we went into lockdown was how do we appeal to millennial investors? What still needs to happen? And I mean, we all meet us at PDAC in Vancouver, at Mines and Money, of course, and wherever in the world. And it's a little bit sad to see that still the average age is quite high of the visitors. And so what needs to be done that we get the young guys in? I mean, not everybody is with Google and Amazon, right?
I mean, there's a lot of issues there. I mean, one is the predisposition of young people. There's that old expression: if you're not a socialist by the time you're 20 or 25, then you don't have a heart. If you're not a capitalist by the time you're 40, then you don't have a brain. But I think the other side of this is that, a lot of the complaints that millennials have is about the history of mining, and the history of mining isn't a good history. I mean, we have to kind of open up and and look. A lot of our dirty laundry is on the scars of the earth left by mining companies of the past. But if you actually look at how mining companies today operate, they don't operate like that. Most companies do their reclamation as they go. They take responsibility for the environmental issues that they face, and most of them are dealt with. And I think there's a big difference between historical mining and modern mining. In my role, we tackle this a number of ways. I'm very involved in the Goodman School of Mines at Laurentian University, and we have spent a lot of time and effort working with the environmental department there, documenting the history of Laurentians in Sudbury, which is one of the most mineralogically endowed places in the world, documenting the history of Sudbury and how the old miners destroyed it and how then they cleaned it up and how the mines operate today. And they operate in a city where people like the outdoor lifestyle and live like that. And we need to get that message out more and better, because the modern mining is not a problem. The other side to the millennial argument is that there's a lot of noise in the mining industry. I used to tell people that mining is a very strange industry, because when you have a mine, people will do whatever they have to make sure that mine doesn't close down. But when you don't have a mine yet, people will do whatever they have to make sure that mine doesn't open up. And that's mostly out of fear. And I think as we've seen the way the mining industry engages local communities, and they're doing a much better job than they did even 10 years ago, and that they can actually bring in modern practices, deal with the environmental issues, and really engage those communities so that the communities actually see that this is a huge benefit for them. I think you're going to see a lot of the protesters and the other side of it start realizing. And the third real aspect to engaging the millennials is that, you know, we live in a world, and right now we're all kind of locked down under COVID. When you take COVID out of the equation, we live in a world that is trying to wean itself off of oil and gas as a carbon producer. All of the solutions to that involve mining in some way, shape, or form. And that's why I say the investment side of the industry has to get its act together, because for the first time, we're part of the environmental solution. And if we're not going to be able to put out numbers that people can trust, we're going to lose that. So to me, I think that the mining industry has a very bright future. And at some point, we're going to stop looking at the past and start looking forward. But we still have some work to do.
Yeah, perfect. Thank you. There is one question from Jacob Ambrose Wilson, and he's asking, what's your take on the view that COVID-19 could deflect the investment focus away from ESG and towards profitability?
Well, you know what, if you think that there's a conflict between ESG and profitability, you're in the wrong business. The reality of it is you need to work. When you work in a community, you're part of that community. Part of that community is being a good citizen in that community. And being a good citizen means you take care of the environment, you have good social relationship, and you practice good governance. And that is how you maximize profits.
Mm-hmm, exactly.
So
sorry, please.
Go ahead. No.
Okay, good. Then we have a question from Debbie Elric. She is asking, what is your approach to ESG in your due diligence within the juniors Dundee look to invest in? Will you make ESG Sustainalytics a condition of your investment?
Well, I mean, our approach to ESG is we actually spend a lot of time looking at the company and talking to them about it. Certainly, you know, we look at every aspect of it. We as Dundee as Dundee Goodman Merchant Partners, we've joined the PRI, the Principles of Responsible Investment. And the reality of it is our belief isn't that this is something you do because a lot of people want to see you do it. Our belief is that if a mining company doesn't have their ducks in a row and hasn't dealt with this properly, they're not going to have a smooth sail, or they're not going to be able to be successful. So it is a very important part of our investment process. Some of these companies are too early to do a lot of analytics, but one of our partners within the Dundee Goodman Merchant Partners is an environmental expert and has spent his whole career. He used to run an environmental consulting firm and has spent his whole career on the, we'll call it the ESG side. They used to call it the CSR side, but certainly engaging and dealing with how are we going to solve these problems and these concerns within the communities and make sure that we're using best practice. So we do take it very seriously.
Mm-hmm. Fantastic. One last question. Can you speak about Dundee Sustainability Technologies, DST, and where do you see it going?
Okay, well, Dundee Sustainability Technologies has two technologies. One is that they have a chloride-based process that can operate in areas, can recover gold in areas where cyanide can't. And the other one is the one I'm going to talk about mostly, which is an arsenic vitrification process. And it's dealing with arsenic. And when you deal with, as we move down the mining curve, a lot of the easy ore bodies have been found. And as you get deeper and into more complex geology, arsenic becomes a larger issue. DST has developed a tremendous technology to take the arsenic and encapsulate it into a vitrified glass product that is so powerful that even if you took a hammer and shattered the glass, it wouldn't release any arsenic. The arsenic's in the matrix of the glass. Getting the mining industry to try new technologies on the metallurgical side can be very difficult. And but that said, you know, when you think of how do we deal with arsenic today, the three ways of dealing with it are really autoclaves, which is very expensive. It turns the arsenic to scorodite or ferric arsenate, which is a good solution, but it's an expensive solution. Bioleaching, which doesn't always have a solution and can be temperamental. And the third way is roasting. And roasting is the cheapest, but as environmentally, you've never known what to do with the arsenic. By using the vitrification on the back end of a roasting, we offer a very interesting value proposition. When we're going to get this thing turned has been the problem, and we're looking at a lot of different things. We're looking at bidding on a lot of environmental contracts, but we're also looking at ore bodies where arsenic is an issue, and we can add significant value through that process, and possibly using it on the merchant banking side, where we can put our own money in behind the technology because we do believe in it.
Okay, super. Thank you very much. Now our time is really running again. And let's come to the next company, Tim Warman, the CEO of Fiore Gold. Tim has over 25 years experience in mineral exploration, resource development, and permitting, with senior leadership roles at Continental Gold, the Radian Resources, and Aurelian Resources. And Fiore is a growth-oriented US gold producer. Their initial goal is to build a new mid-tier gold mining company and become a 150,000 ounce per year gold producer through internal growth and strategic M&A. So over to you, Tim, and let's see how Fiore does and how is it going there.
Yeah, it's actually going very well. Thanks, Jochen.
I know.
And yeah, I mean, I think operationally, we've been very fortunate in Northern Nevada where we operate. There's been fairly minimal impact from the COVID-19 situation. I think in the county where we operate, there's only been 3 cases, from the start. It's a pretty remote and sparsely populated area. And of course, all the mines in Northern Nevada are working together, from the small guys like us up to the Nevada gold mines, and sharing best practices and ideas for keeping people safe. And, and really, I think virtually none of the mines has seen any significant impact, which is fantastic. On a company level, I think, the ability to operate in Nevada as it's a fantastic jurisdiction, and our Pan mine, which is the operating mine there, has really, I think, an efficient and kind of unique for the junior producer phase, a profitable mine. As Jonathan said, there's a lot of numbers being thrown around out there, but we fundamentally try to operate as a business, and not as a promotional vehicle. And so our mine makes money. It's allowed us to, add cash to the balance sheet. It's allowed us to fund our growth. We have no debt. We haven't issued any equity since 2017. And so we're really self-financed. And that was always the goal because, we really want to grow the company. And we've got an organic growth project next door in our Gold Rock project. It's permitted. That will more than double production in Nevada. And then really focusing on some strategic M&A. We think there's a real demand for a US-based gold producer that has exclusively US assets. And just, I'll give you an interesting piece of trivia. We are the largest US gold producer, and we produce just under 50,000 ounces a year. So if you look at companies that only produce gold exclusively from within the US, we're the biggest. And that really tells you that there's an unfilled niche, and that would be particularly attractive to US investors, who could look at a potentially a 150, a 200 to 250,000 ounce producer created by bolting together some of these small single asset producers that are going to struggle on their own, that don't have a lot of growth potential, and really makes create a vehicle that's really attractive to both U.S. retail and U.S. institutional investors. And really that's our aim at the end of the day.
Mm-hmm. Wow, fantastic. That was fast. Great. I mean, what we maybe should mention that you are already, of course, producing, as you said, out of the Pan mine. So for this year, you plan approximately 45 to 48,000 ounces and profitable. That's really important. Also, your company has no debt, which also helps a lot. So what is next for the Gold Rock project?
Yeah, so our Pan mine, the operating mine, is running really well. There isn't a lot of optimization to do there. So the focus is now on Gold Rock. As you said, we've gone through the permitting process. That was all finalized in 2018, and we just finished the PEA on the project. And now we're moving straight into a feasibility study. We'll have the feasibility study completed by about the middle of next year. And it's really looking to build a satellite operation to Pan. They're only 8 miles apart. They'll be run by the same team. They'll be built by the same team. And So there's a lot of drilling going on. There's a lot of metallurgical work going on. There's a lot of geotechnical work going on. All of these things that feed into the feasibility. So we'll be spending $8 or $10 million over the next 12 to 14 months to complete that work. Again, all of that funded from our own cash flow, and really hoping to get to a production decision around this time next year, and then straight into construction and get that thing built.
Fantastic. How many ounces do you think you can produce out of that?
Well, right now under the PEA scenario, we'd be looking at about 56,000 ounces a year. So combined with the production from Pan, that gets us over 100,000 ounces a year. But one of the things we're really going to focus on is drilling to expand the resource. It's a very large mineralized structure. It extends for about 16 kilometers through the area, and we've only really drilled a small portion of that. So lots of upside on exploration, and we think lots of upside for optimizing it from the engineering and the metallurgical side as well.
I don't want to run into politics really, but in 6 months you have elections, right? And no matter if you like Trump or not, we don't care about it, of course. But what do you think might be the impact if Trump wins or Biden? Do you see any heavy impacts for the mining industry? I mean, for uranium, for example, it's already very positive, right? Yeah. Because they want to buy a lot of uranium for the next 10 years. And I would say Trump is really mining friendly for sure. But what's your view on that?
Yeah, it's an interesting question. I mean, I'm a Canadian commenting on American politics, but obviously I've had to become a bit of.
But you work in Nevada.
Yeah, absolutely. Look, mining is extremely important to the Nevada economy, and I think that gives it a lot of momentum in that area. And I'll tell you, one of the things we're discovering is, regardless of who's in the White House, change happens very slowly in the US. And, I think, the minute Trump got elected, everyone said, well, things are going to be permitted in 6 months or a year, now, and everything's going to move quickly. And I'll tell you, changing a bureaucratic regime, that's the regulatory side of things, and the bureaucrats and all the different agencies, it's like trying to do a U-turn in a super tanker. It just doesn't happen overnight, and there's resistance to it. And so, all the people that said the world was going to change and everything was going to be roses with the Trump administration coming in, I have yet to see a project being permitted in a year. The guys who were saying that it was going to be permitted in a year, well, that was 2 years ago, and I'm still waiting, to see their permits. So, and again, the same if Biden comes in. I mean, you might look at stronger environmental regulations and whatnot, but they're already pretty strict in Nevada, and I don't see that changing overnight. I really don't. Change just doesn't happen that fast. The whole U.S. system of checks and balances is designed to slow down drastic and sudden changes, and it works beautifully.
Fantastic. There was a understanding question, Tim. You did not say that Fiore is the biggest gold producer in the U.S., right?
We are if you look at companies that produce 100% of their gold in the United States, we are the largest U.S. producer, which is, it's crazy. And it just shows you, as I said, there's an unfilled niche there that we're trying to fill.
Fantastic. That's great. Super. Then Fiona Chesford or Kesford, I don't know if I pronounce it wrong, please forgive me. How easy is the permitting process in the US, and especially Nevada, and what time frames are you looking at?
Yeah, so I mean, the permitting process it's very well defined, but of course in the United States, litigation always comes into things, so that's always a risk. I like to joke that, after football, litigation is America's second favorite sport. And, I mean, for the Gold Rock project, our growth project, it took 8 years to permit that. Now, some of that was caused by the pause due to the bankruptcy of the previous owners of these assets. But, generally, it is a multi-year process. Fortunately, all of our current projects, Pan and Gold Rock, are fully permitted at the federal level, which is the long, drawn-out processing period. We'll still have to get Nevada state permits for Gold Rock as we move it along. And those are typically a kind of 6 to 8 month process. They're very much more, design oriented. You submit your design drawings for the things you're going to build. You look at quantities and equipment lists and that kind of thing. And it moves on pretty systematically. They don't tend to be the long drawn federal process that's behind us already.
Great. What are the future plans for the drilling programs at the Pan mine in Nevada, and how do you see the mine life there?
Yeah, so we actually
are allowed to speculate.
Yeah, we've actually just finished up quite a large program. We just finished up about 50,000 feet, or about 18,000 meters of drilling at Pan, with the goal of growing the resource and the reserve and extending the mine life there. We were very successful in 2018 in extending the mine life, and we're confident that we're going to see another mine life extension. From this current program. It's a much larger program than the previous one. That will come in the second half of the year, by the time we get all the assays in and do the resource and reserve calculations, and then build another mine plan around that. It'll be the second half of the year before we see that. But we're pretty confident. It's a very big land package. It's 200 square kilometers, one of the largest held by a junior anywhere in Nevada, and lots of fertile ground for exploration there. And of course, as we mine and as we drill, our geologic understanding is just getting better and better, and we're getting better at targeting some of the mineralization there. So yeah, we're quite confident that Pan probably will never have a 10-year mine life, but I suspect 10 years from now we'll still have a 5-year mine life.
Yeah, that's how we know it. Fantastic. One last question. As you stated, you are the largest 100% gold only producer in the US. Yeah. Of course, we want to have your take for the gold price this year and next year.
A very well-known figure in the mining industry who I've worked a lot with over the career. He was on BNN once, and at the end of the interview, they said, and Patrick, what's your view on the gold price? And he sort of looked at them for a minute and said, and I have to say, I'm a geologist by training. I could tell you what I think the gold price is going to be, but at the end of the day, it's tough to predict. I think we're definitely in a strong gold price environment. I think the economic backdrop. I think the supply, new mines, simply aren't replacing existing production. I mean, if you're Barrick, how do you find 5 million ounces a year just to stand still? And a lot of people will say, well, yeah, the majors aren't finding new reserves and resources at a rate to replace production, but the intermediates are there, and the juniors. But I mean, the scale is just so vastly different. I mean, all of the new finds by the intermediates, would barely replace a year's production by one of the majors. So I think that, there's been a lot of talk about peak gold. And of course, as you raise the gold price, you start to bring some marginal assets, into production. But again, that's not quick. It's you can't just turn a mine on again. So I think there's kind of a bit of a perfect storm supporting precious metals prices.
Yeah, I see it the same way. Maybe then let's turn the question: where are your costs heading?
Yeah,
because this is something you really know.
Yeah. Our at our sort of typical life of mine, our all-in sustaining costs across the the whole company are around $1,100 an ounce. This year we've gone into a slightly higher stripping phase in the mine. Our strip ratio has gone up from 1.6 to 1 to 2 to 1. That's a very temporary thing in the mine plan, and in fact those strip ratios started to fall off again. So we probably peaked up around $1,200 an ounce in terms of all-in sustaining cost, but that's starting to fall, and we'll see that over the next few quarters. So it's a pretty robust mine. We don't need $1,700 gold, to be profitable. Even at $1,500 gold, which was I think we were less than $1,600 gold on realized gold prices in the last quarter. An annualized, the mine, relatively small mine, would be throwing off somewhere 20 to 25 million US in operating cash flow. So, at $1,700, it looks great, but even at $1,300, it's a decent little producer.
Fantastic. Tim, thank you very much. Yes, Jonathan.
Given that I'm just going through your presentation on my phone as we talk, but given that how close Pan and Gold Rock are you going to get a lot of cost synergies there?
Yeah, we think so. And in fact, the PEA didn't capture all of those synergies. I think we'll capture a lot more of them in the feasibility study. These are low-grade open pit heap leach type deposits, so you're not going to truck ore. I mean, you've got to build leach pads anyway, so you might as well build them close to the open pit. But in terms of using some of the existing facilities like the ADR plant, where we pull gold off of the loaded carbon, and where we refine gold and produce the gold doré and do the assaying, and all of that is, ideally is going to happen at Pan, where we already have those facilities. Of course, the same management team will be there. We're not going to build a new administration facility down at Gold Rock. We're not going to put a new management team in down there. So yeah, there's a fair bit of synergy involved there.
I would think that you don't need. You can have the same group of mining engineers and the same group of geologists.
Exactly. We'll probably use the same mining contractor. We'll have a common fleet. So if one mine needs an extra truck or an extra dozer for a few weeks, we just drive them across between the two. They're only 8 miles apart. So
I'm sure Raziel will call you after this shortly too.
That's for sure. Okay, thank you very much, Tim. And honestly, I want to see those $2,000 go, because I wait 8 years now to see that, and it cost me a lot of red wine to bring my nerves down. Yeah, our final guest, Matt Geiger. He is a long-term value investor based out of San Francisco in California. His MJG Capital Fund is long only and holds a concentrated portfolio of mining and resource equities. The fund has outperformed the S&P 500 and TSX Venture Index over 1 year, 3 year, 5 year time horizons as of his January 2020 investor letter. So Matt, great to talk to you. Great to see you. How has the MJG fund been hanging in there in light of the tremendous volatility we've seen this year due to COVID-19 and the associated economic disruption? The floor is yours.
Absolutely. Well, thanks for having me here, Jochen, and the rest of the Minds and Money panel. This has been fun. I don't want to go into specific results at this point. I prefer to wait till our July investor letter, which is coming out pretty soon. And if anybody on this call wants to get on the email list, I'd invite you to drop a line on our website, and I'll make sure you're on that. But yeah, I can say things are going very well. Obviously, we were hanging on with white knuckles along with everybody else in the first 2-3 weeks of March. That was one of the sharper episodes of selling that I've ever seen, and I don't think I'll ever forget March 13th, which is the day where the GDXJ were down 35-40% intraday, and it really did feel like the world was coming to the end. Even for an investor like myself, there were a couple days where it was tempting to play the fool's game and sell and try to get back in at a lower price. But as we know, that never works. You have to be right twice. And usually the best case scenario is just to hang in there with your picks as long as your investment thesis is still intact. It's definitely helped that 60% of our portfolio is weighted towards precious metal equities. So we have caught this move over the past 8 to 9 weeks pretty flush. But I'm staying quite cautious here. I said in recent interviews, my base assumption is still that we're going to test the broader market lows or even break below those in the coming months here. And so for any investor, really, if you're looking at gold juniors or any other mining investment across the spectrum, I really feel you should be very selective and confine your bets to stories where even if the share price were to fall 30-35% over the next 3-4 weeks, you have the conviction in the story and the conviction in the people involved that's not going to cause you to sell. As long as the thesis remains intact, you're going to hang in there and if anything, add to that position. So I know, especially in times like these where there's a lot of green in our screens over the past few weeks, I think it's important to keep that in mind and really focus on stories that you can hang in there when we have our next bout with volatility. So I think that's just a matter of time before we see that again. So I'll keep the preamble short so we can get through some more questions here.
Super. Thank you very much, Matt. Any questions here from the audience? Okay, then I have one for you. As you have described yourself in previous interviews as a people-first investor. That means you are betting on the jockey and not on the horse only. So can you give us a bit of an idea how you determine whether a management team is properly aligned with shareholders, or what is important for you? How does that work?
Absolutely. So that's a bit cliche.
Sorry?
Go ahead, Jochen.
No, I said you are doing this like I do sometimes. I go with them and have a drink or play 18 holes of golf, and then you know who people are.
That helps too. That helps too. You can't get too friendly though, because you still have to make the right decisions. But I think it's very important to get to know the people personally. And a side note, that's what site visits are really good for. You'll be able to glean insights that you'd never be able to in a 30 or 45-minute Zoom call with management when you're able to spend a couple days with them. So that's very important. But the horses, or the jockey and not the horse statement, very cliche, but I truly do believe that. Really in any industry, the earlier stage you get, the more and more important the people are. Apple or Amazon, you could probably replace Tim Cook or replace Bezos and put in a mediocre CEO. and those companies will do fine for 3 or 5 years. There's no risk. But when you're in the junior space, you have CEOs, including the ones on this call, that are making life or death decisions on a weekly or monthly basis, that have massive implications for the shareholders of their companies. So I really do feel that you need to focus on the people first and foremost. And, while I do have my preferences on certain metals over others, I'll just emphasize, I would much rather invest in a very high quality management team that I trust and that I've made money with before, in a commodity where maybe I'm a little bit bearish or not as excited as. So just because you're bullish on, say, gold or uranium or silver, you really can't have the mentality that you just go out and buy anything with that metal in the name. That's for sure. In terms of determining whether a management team is properly incentivized, I mean, that's a long conversation in its own right. I'd say, the few factors that come to mind and what I look at, the most obvious, of course, is skin in the game. I think especially for these earlier stage juniors, it's not unreasonable to want management to have close, if not more than 10% management in their story. And honestly, the higher, the better. So just pure, board insider management or ownership is a very important metric. Second would be the management's cost basis. A management team that owns 20% of a company, that's good no matter what. I'll concede that. But I'd much rather get in at a price that's close or below to the price that management got in. A team that owns 20% of a company but is already up 10x or 8x on their money, it's going to behave a lot more differently than a management team that's in close to the current market price. So that's another thing that I look at. A third thing that comes to mind would be whether these shares were obtained with real dollars, whether management stumped up their own money and put it into the company. I understand for some first-time CEOs, that's not possible, especially if you don't have your own big bank account. So there are some exceptions, but I'd much rather see a management team stump up their own dollars than, get a bunch of cheap, 1 cent or 5 cent options. Just quickly here, another two things you'd want to look at is, of course, management's all-in compensation. That includes what they're getting with stock and RSUs and options. Make sure that it's comparable to peers or ideally less for the stage of that company. And of course, the closer you are to exploration or prospect generation, the lower you want that number to be. The royalty codes and the bigger producers will have higher salaries generally, but sometimes for good reason. And then the final more obscure point I'd touch on is change of control clauses. And not a lot of investors look at these, but these can be found in the company's information circular that's sent out once per year. And you want management teams that are incentivized to make money on this project and the story because they have skin in the games themselves. And some well-known companies out there that have excellent assets. If you look in the fine print, they also have CEOs that are going to get $6, $7, $8 million payment if they sell their company in the near term. And that can result in perverse incentives and maybe a management team that sells earlier than they should and earlier than in the best interest of shareholders. So I'll stop there, but those are all the things I look at when evaluating a team's.
Yeah, then let's move away from, let's say, management. What is your take on now? If you need to invest, do you say, well, better maybe to go into producing companies because they have cash flow, they are not only well financed, maybe they have no debt and they are more safe in that environment? Or do you prefer, for example, royalty streaming companies? Or do you say, well, maybe the combination out of that makes sense and it's time maybe to look at cheap explorers which have not moved up? What's your take on the market situation now?
Absolutely. Well, I would say to each his own in terms of the different business models to invest in. I would pound the table and say, if you want to, besides owning physical metal, owning the higher quality royalty companies is the safest way to go. And that's been a surefire strategy, for the past 15 years, honestly, especially in North America in the precious metal space. The royalty business model has really come in and taken over. And just look at Franco-Nevada. That's the craziest example. You see them enter the 2011 to 2015 bear market at a lower share price than where they exited in 2015. I can't think of a single other mining company that got even close to that level of performance. All that said, I do firmly believe we are, in the mid to early to mid stages of a new precious metal market here. And especially the relative performance of the royalty names relative to the producers. I think over these next couple of years, we may see revenge of the miners, as Robert Friedland likes to call it. I'm referring to a slightly different phenomenon here, but you do get significantly better leverage with the actual operators. And of course, that sword cuts both ways. But in a rising gold and a rising silver price environment, that's probably where you're going to see your longest gains or strongest gains. So, funny enough, in our portfolio, we actually don't have any operating miners in the portfolio, which is pretty shocking to people. Our production and cash flowing names are all royalty names. But I'm focused on the high quality development projects that I think can be built or at least taken out in this cycle. And also myself and a few investors that I very much look up to have been focused on the prospect generation business model for quite some time as well. So about 20 to 25% of our portfolio is exposed there. So I'm more focused on takeouts and new discoveries. But by the same token, I want our producers to continue churning cash here, paying bigger dividends. The M&A spree that we're seeing is going to continue. And I think that's good for the whole space, even though we're focused on the earlier stage names versus a company that Tim or Brad are working on right now.
A friend of mine told me yesterday in a phone call that the US generalist money is flowing into the mining sector. And what is your take on that? Do you see that also?
It's real. Yeah, I mean, all you have to do is read the headlines, but you've had investors from Ray Dalio to Paul Tudor Jones pounding the table on gold for the first time in a long time. I think a lot of people that bet on precious metals in the wake of the great financial crisis in 2008 remember the 2 to 3 very strong years that followed. Obviously, that rally cut off a lot sooner than many people expected or would have hoped, but that was one of the better trades coming out of the last financial crisis. So I think that's still relatively fresh in people's minds here. But yeah, in terms of generalists coming into the space, I mean, it's real. Look at the GLD, not the price of the GLD, but the actual physical metal holdings, that is backed by the GLD, and it's rising week on week on week. This is real money coming in from Wall Street. It's no longer, your typical resource or gold bugs that have really, been the only players in town for many years now. So I think it's positive for the space. Eventually here though, we're going to have to sell. So keep that in mind. I don't think we're anywhere close to that. But when you start seeing every third article on CNBC or the Wall Street Journal about gold and precious metals, maybe that's time to get a little bit more cautious. But I still think we're early enough in kind of this generalist shift into the space where there's nothing to be too concerned with at this point in time. It's exciting. It really is.
Yes, probably when you read in the Daily Mirror that the housewives are buying mines, then it's time to run.
I think so. Nobody went broke taking a profit, Johan. Yep.
Yeah, that's right. Super. Yeah. So from my side, I think we are just into time. I think we are fine on that. First of all, thank you very much to our audience here, to our participators. Thanks for staying with us 1.5 hours already. And thanks to Bradford, Cooke, to Raziel, Zisman, to Jonathan Goodman, Tim Warman, and also to Matt Geiger. Fantastic information you guys provided. Very good companies, great investments. And I really urge everybody to do some due diligence on the companies. And Andrew, now I give it back to you. Thank you very much. It was a pleasure to moderate that.
Thank you very much for that,
Thanks,
Jochen. And thank you back to all of our guests, our sponsor, Whittle Consulting, and the audience for dialing in. Our next episode in this time zone will be 5 p.m. British Summer Time on the 4th of June. Until then, stay safe. Thank you very much.
Thank you very much. Bye-bye, everybody.
Thanks, guys. That was fun.
Bye-bye.